Hello everyone, this is Vernam, Assistant Professor of MBA Department of SNS College of Technology. Friends, in today's session we are going to discuss a concept under marginal costing. So before entering into today's session, we shall have a short recap of what we have been discussing in the previous session. So in the previous session we were discussing about marginal costing. So it is an accounting technique which includes variable cost, fixed cost, which helps us to understand clarity on how the increase in the volume of output increases the cost. So that is what the marginal cost, the additional cost which has been incurred for producing the additional volume of an output is what called as a marginal costing. So in today's session we are going to discuss a concept in marginal costing. So before seeing what the topic is all about, can you guess what the topic it would be about? So what determines a business starts making profit? It involves cost, revenue, hint 1, total revenue equal to the total cost, the critical sales volume threshold. Yes, obviously. So the answer is break-even analysis. So today we are going to discuss about break-even analysis. Yes. So what is a break-even analysis? A point or a volume at which the total revenue is equal to your total cost is what called as a break-even point. It is a point where the company neither achieves a profit nor it is suffer with a loss. So that point is what called as a break-even point. So break-even point is very essential for a company to decide about the pricing strategies and also to have some cost control initiatives, and this is very important for a company to take an investment decision. So break-even point, the formula for computing the break-even point is fixed cost divided by contribution per unit. So this is what the formula for the break-even point in units. So what are the components in the break-even point? So when we talking about the components in the break-even point, we can categorize into three: fixed cost, variable cost, contribution margin. So fixed cost, a cost which remains constant is called as a fixed cost. So irrespective of changes in the volume of production, if any cost, if it remains same, constant, that is what called as a fixed cost. Example, rent, salary, insurance, all this is a fixed cost. Variable cost, a cost which varies according to your volume of your production is called as a variable cost. Example, so when there is changes in your production units, obviously the raw material requirement will also change, labor requirement will also change, packaging cost will also vary, shipping cost will also vary, right? So all this is what called as a variable cost. Contribution margin, so the selling price minus variable cost per unit is what called as a contribution, that is sales minus variable cost is what called as a contribution margin. So which covers the fixed cost and generates the profit. So I have given a small example. Fixed cost is 75,000 rupees, selling price is 8 rupees and the variable cost is 2.50. So in order to calculate the contribution, as we were discussing, the formula for contribution is sales minus variable cost, right? So the sales is 8 minus the variable cost is 2.50. So it comes around 5.50 per unit. So this is what the contribution. So to calculate the break-even point, the formula is fixed cost divided by contribution per unit. So fixed cost is 75 divided by contribution per unit is 5.50. So that comes around 13,636 units. So in this we can come to an understanding that if the company is producing 13,636 units, the company will not suffer with a loss, nor the company will earn a profit. So in case in the conclusion we can tell that the company should go more than 13,636 units, then only they can earn a profit. So, this is what break even chart. See, in this picture you can see this as a break even point, right. So, if a company earns more than this, the company will have a profit. So, this is an income curve and this is a cost curve. The point at which the income and cost meet, that is what called as a break even point. That is the point at which your cost is equal to your revenue. This point is called as a break even point. In this case, if this company is producing less than the break even point, this is their loss area. So, if the company is producing less than the break even point, it is a loss for the company. This is a point of a profit. That means, if the company is producing more than the break even point, they will earn a profit. So, we will know if a company should earn or the company should produce more than the break even point, then only the profit can be earned by the firm. So, mind mapping of break even analysis. So, break even analysis, it helps us to have understand a clear understanding or to have a better understanding about the relationship of various factors, right from cost, revenue and profit. So, with the help of the break even point, we can understand clearly on the cost aspects, revenue aspects and profitability aspects of the company. So, we will come to the conclusion part of the the session, summarizing part of the session. So, in today's session we were discussing about break even analysis. So, break even analysis is a point at which a company neither suffers a loss nor there had been earned a profit. That point is called as a break even point. No profit, no loss is called as a break even point. In break even point, we have seen what is fixed cost and what is variable cost, and we were also discussing about the contribution, that is sales minus variable cost is what the contribution, and we were also discussing on the importance of the break even point for the company. So, hope like you would have been understood with today's session. Meet you all in the next session. Thank you for listening.